Happy Friday, February 20th. Can't believe we're almost wrapping up February here in 2026. My name is Dano. Weir. I'm the marketing director for Sonoma Wealth Advisors and the Fermata Advisors family of brands, and we're about to go on the markets. And our theme this week took a turn with the striking down of the president's tariff authority. How did the market react to the Supreme Court ruling today? We'll get into that. Why the market might be fearful of the Hyperscalers' latest superhero team, the Cap-Ex men. First is gold, second is silver. What medal in the Olympics do you get for coming in last place? Coal? Because pending home sales gets that medal this week, an all-time low. We'll look at that. And the S&P is holding on for its dear life, and what the oil market might be saying about Mid-East tensions. Let's go.
The stock market, the economy, your money. What's the latest and what could be next? Find out now with Fermata on the markets. Straightforward financial market updates for the brands of Fermata Advisors, Sonoma Wealth Advisors, Fermata 401k, and Fermata Tax. On the markets starts now.
Bring in the managing principals of the firm, Sonoma Wealth Advisors, our private wealth brand, and the Fermata Advisors family of brands. Daren Blonski, CFP, Chris Sipes, CFP. Guys, we are living in a world without tariffs. Well, with less tariffs. Your gut reaction when you first heard that today, Chris?
Not surprised, because the prediction markets had assumed, I think it was like a 70% chance, roughly, that the Supreme Court was going to strike down the tariff. So, not surprised.
And to be clear, they've struck down his ability to enact this emergency powers for tariffs. There are still some that are in place, but it's certainly massively reduced, Daren. And I mean, are they going to have to refund all this, or what happens now?
Yeah, I don't think anybody knows that. That was the interesting reaction. I thought for sure when that came out, even though it was predicting that it would happen, that the markets would react a little bit more than they did, and the markets just said, meh, don't care. And I thought that reaction was fascinating overall, and I don't think anyone knows. They, in the Supreme Court ruling, they did say it could cause a lot of mess when it comes to refunding these, but we shall see. Although I was talking with Chris earlier today, and we were thinking about this, and this idea came to me earlier this morning when I was thinking about, Trump's been pushing heavily on Chair Powell to lower rates. Why? Because it's very beneficial if rates get lowered before the midterm elections. And then I started thinking about this. If Trump has to pay back $150 billion to these companies that they put tariffs on, a lot of them are U.S.-based companies. Well, that could be really interesting from a market stimulation standpoint. And it might end up being quite the clutch geopolitical move. Like, oh, okay, I'll pay back $150 billion to all these companies. Wow, that would be nice for the market. So anyway, I think there, like any situation, there could be some real positives that come out, at least for the market standpoint. But that also means that our government just goes more broke, paying more money into the economy and blowing this bubble higher.
And I'll say something too, because, there's a take it back to the fall, or take it back to whenever the ducks start lining up, and people, I want to be really gentle here. You see that, a president is allowed to pick their Supreme Court, and they're going to put in the people who, are going to vote their way or whatever. And it's an all conservative Supreme Court or whatever. John Roberts, the Chief Justice, was put in by Bush, and that's not a left-leaning judge per se. So one thing that was interesting, I think, about this ruling is if you have this idea that it's all lockstep with party, this is an instance where that didn't necessarily happen.
That's right. So this week's meme really has nothing to do with anything
Hey, Chris,
we're
you're
just talking
super
about.
quiet. Can you talk?
Sorry,
into the mic a
is that
little bit
any?
more?
Is that any-
Yeah, there you go.
Sorry, this week's theme has really nothing to do with what we were just talking about. Thought it would be funny anyway, since we talk a lot about AI and all the things that AI can do and all the things that it's promised to do. So hopefully that gets some laughs this week.
Yeah, we're looking at a meme for audio audience. It's a guy looking at a computer, and he says to the computer, "Say I am alive," and the computer says, "I am alive," and the guy goes, "Oh my god."
Yeah, I got a kick out of that. I got a kick out of that. But anyway, back to tariffs. As you said, the tariffs that were put on, using the emergency powers were basically what was struck down. And Gorsuch wrote the, I guess, majority opinion, which you can read here. And essentially it says, like, look, things like this should be done by Congress. And even though it's takes longer and it's way sloppier and all of that, it is the way that it should be done for the longer term better of everybody, because it doesn't get changed as quickly. Like, essentially changing it day to day isn't what the law had in mind, essentially. And then we got from Kavanaugh a dissent, and as Daren was saying, part of the dissent was like, what do we do now? But he also says, hey, look, that's not for us to decide. We're just supposed to judge on the law. But he does say the United States may be required to refund billions of dollars to importers who paid the IEEPA tariffs, even though some importers may have already passed on those costs to consumers or others. As was acknowledged at oral argument, the refund process is likely to be a quote-unquote mess. And
it's
then
a
he goes
mess
on.
when the Supreme Court calls it a mess in their formal document. Like, what else are you going to say? It's a mess.
It's a mess. And then he goes on to talk about, like, also all the the trade deals that were done based on the premise that these tariffs were a thing, the leverage that was used. So who gets refunded, who doesn't, how does it work? Guys, I'm not going to spend my refund check until it hits the bank. I'll tell you that. I'm not going to expect anything. I don't know about you guys.
Yeah, I mean, I think you have to. What he attempted to do is unprecedented, at least in the modern era. So you have to, as is often the case with him, and therefore you're going to be in uncharted territory as a result. And he was seeking uncharted territory, which is, a government that's financially imbalanced. And now we're in uncharted territory as a result. So, one thing that I think that concerns me is that, it says like that the United States may be required to refund billions of dollars, which sounds like very legal, right? But at a certain point, it gets down to required by who? I mean, what is your recourse against the United States government? And maybe not so much for the companies, but for some of these countries, So it's like, if he doesn't have the tariff as his threat, then the only last threat is like the military, So like, it will be interesting to see, how much actually does or doesn't get repaid and what gets resulted. And we hope that things, just everybody keeps cool heads, I guess.
Yeah. And remember when these first came out, there were companies, I won't mention any, but companies that you do online ordering from, and they had put a separate line item that said, additional costs due to tariffs. Basically, they were actually separating it out as a line item expense. Had that stuck, of course it didn't, because they got a lot of heat for doing that, but had that stuck, it might be a little easier to refund, who actually paid what and when.
Mm-hmm.
But now how are you going to sort that mess out? Now, in terms of the market, though, if you think about like who are the winners, at least based on today's price action, because if you look at price being the final arbiter of truth, well, you could say really the stock market, the U.S. stock market, was up a little, so it was like okay, it's a good thing for stocks in general. But however, the small stocks were flat, so there was no response by the small stocks for whatever that, take that for what it's worth. Interest rates were up slightly, which, kind of across the curve, interest rates going up a bit. Also a little counterintuitive. Maybe that's pricing in more growth. I don't know. Emerging markets, really the big winner on the day. You had markets like South Korea, South Africa, India, Brazil, all up pretty significantly on this news. Mexico. So some of the strength that we've already seen in the foreign markets, even with the tariffs on, just continued, right? So that's interesting. Sector wise, the large growth had some good responses. The communications sector, consumer discretionary, we saw some strength there. But gold, the old story, right? As we've been talking about for what seems like a long time at this point, gold, again, another strong day. It just continues to see that momentum. So anyway, that in terms of how the market is responding, it's interesting to see how these various asset classes are responding to this information that was, again, largely baked in, because I think the probabilities were very high that they were going to rule against the tariffs, at least in their current form.
And I want to say this just to give you peace of mind. This is not to say that you listening or someone who did this was wrong. I want to give you peace of mind, which is to say, in April, tariffs are enacted, and the U.S. market, among many others, got smoked, right? This massive, to the point that we had to do an emergency live stream to try to talk about it, right? So therefore, the exact opposite should be that when the tariffs go away, the market's going to surge. No. No, yeah. So like today it was just like meh. So what a perfect example that it is not the same set of circumstances. And if you're feeling like, man, if only I knew, or I should have known, or when it happens after the fact, I should have known that, it does not compute. The math does not work how you think it always will.
Very, very well said. And if you just looked at the market, at the numbers today, and you did not know that the Supreme Court had ruled, I don't think you would have looked at the market and go, "Oh, something definitely happened." It was like just a continuation of the trends that we've been seeing. So, anyway, now this from, let's see if I can, Brian Sozi, and showing the mechanical kind of step down of the tariffs. So what's interesting, so going back to countries that did deals, those are the ones that are highlighted here with the yellow. So there was a deal done with the idea that the IEEPA tariffs would be, relaxed. Those IEEPA tariffs were a part of that deal. Then you've got the no deal IEEPA based tariffs, China being the largest recipient of those, but also the rest of the world kind of significant there. But you've got a lot of countries like Indonesia, Japan, the UK, several countries that did deals based on these tariffs, and so it'll be interesting to see if there's any changes there now that they've been ruled against. So, and then you see the actual tariff rates. Along with the tariff level X IEEPA, meaning like if IEEPA is removed, where would that tariff level be relative to their actual tariff rate, which is quite a bit lower. Now, it's too early to, haven't been able to do all the analysis. All this happened today while we're still meeting with clients and everything. So, but my understanding is that President Trump reiterated another 10% tariff kind of across the board, using some sort of temporary tariff that is within his power to use, but you can only apply it for 150 days. So, and I don't know all the rules. Maybe they get to 150 days, they say all the tariffs are relaxed for 20 minutes and then put them back on. I don't know how that works, but you can see that the amounts that have been wiped off in terms of the tariffs is fairly significant based on those IEEPA rates.
And Chris or Daren, let me ask either of you this question. So if we're removing the United States' ability to negotiate country to country, does it then just take it down to business? As an example, NVIDIA was greatly restricted on their ability to do business with China as a result of some of these tariffs. So now instead of having the United States able to levy policy that dictates terms, basically remove that layer, and now it's just up to Amazon to have morals and not, do deals with countries that are perhaps not keeping the American standard?
I feel like even the sentence "Amazon have morals" is an oxymoron. Dan.
Exactly.
I don't know. I mean, the question is I don't know, and that's the answer to the question. It appears though that Trump has a backup plan, whatever the heck that means. And
well, yeah, I mean, when you're playing 4D chess, there's 4 levels, and there's a 5th level too. So he's always got a backup plan, right?
Like I was thinking about this going to earlier conversation, but I was just like, dude, I can just you just know that Teflon Don is gonna say, hey, oh yeah, this was the plan all along. Now I have $150 billion to dump on all these companies over the next 2 quarters. Oh, magic. Midterm elections. It's the economy, stupid.
Yeah.
I could just see him taking credit for that.
Agreed.
Good prediction there. So, okay, we've got the sentiment predictors this week, and the bearishness has inched above bullishness for the first time in a little while. So the bearish ticked up to 36.9, while bullish is at 34.5, but still roughly within the kind of normal ranges of usually around a third in each bucket of bullish, neutral, and bearish. We've got the CNN Fear and Greed Index about the same as last week at 39 fear. It was at 35 last week. And then Bitcoin, wow, ticking all the way up to 9. We're almost in double digits at extreme fear. Last week we were at 5. So Bitcoin crawling out of the doldrums of sentiment as it follows price as always. So, okay, where does all this lead? Because before the tariff decision, we were going to talk about inflation and interest rates. And the Fed came out with an interesting little nugget this week in their minutes that they actually refer to the prediction markets. We don't call them betting markets. We call them prediction markets.
Oh, of course. It's prediction. It's not betting.
Yes. It's the prediction markets as a source of data. And so if it's good enough for the Fed, it's good enough for Sonoma Wealth here. And we've got the Fed decision in March. You can see that they're going to the market expects a maintenance rate, maintains the rate. The cuts rates at only 6%. So very low percentage chance that they cut in March. And then we look at the number of cuts in 26. This is interesting. We are kind of neck and neck with 2 or 3 rate cuts. But look at the jump in 1 cut, kind of creeping up. And that was another big thing with the Fed minutes this week is that, reading the tea leaves, they were kind of leaving it open for, not hiking, but they were saying like there's less and less reason to cut. Even some of the newer appointees were a little more hesitant with some of the inflation and PCE numbers that have come out. And so, I think that's going to be obviously a hot potato for Mr. Warsh to deal with when he becomes the Fed chair after May. But it's interesting that the markets are slowly pricing out these rate cuts due to the stickiness of the inflation numbers in the markets.
I want to give one grain of salt on prediction betting markets, which is that because these are becoming more and more interesting, obviously it is data and we follow indicators wherever it may be. But when it comes to betting, and Daren, I found a way to make it football. The line in football is designed to attract business, is designed to attract flows. So that's why you'll often see it move when as a game gets closer, because as more money piles in for one particular decision, they will move the line to try to attract more business. So when we're looking at prediction market data, know that yes, it's in one way saying how much they think it's going to happen, but in another way, they're moving it so that it'll attract, some payouts and attract some inflows. So just a grain of salt, I think.
Yeah. Now, for those that might be wondering, like, how do interest rates, why does inflation matter for interest rates? The answer to that is interest rates are the price of money. Money is a commodity like anything else. That price of money is the interest rate. And if you are a fixed income investor, if you're going to buy a bond and you're going to invest your money for a long period of time, in return, you're going to get a coupon on that bond. So let's just say it's a 10-year bond. You're going to buy a 10-year bond from the US government, and that rate is going to be fixed when you buy that bond. Now, because it's fixed, you as the investor have to look ahead 10 years and say, is my money going to make at least what inflation is, right? I don't want to lose ground. I don't want to lose purchasing power to inflation. So as an easy example, why would you invest your money at, say, a 2% yield if inflation is running at 4%? You're like guaranteeing yourself a 2% loss, right? So, and fixed income investors, bond investors are not dumb. These are mostly like institutions like insurance companies and pension funds and things like that have long-term obligations that they have to meet. And so they have to look into the future to make sure that they can invest to meet that. So inflation is very important for that calculus, and not only the actual rate of inflation, but the volatility of that inflation is very important, as you can imagine, because when trying to judge what that rate should be over time, if it's more volatile, it's harder to judge. It's more uncertain. So that's why inflation is so important for the rate cuts. And the Fed they don't operate in a box. They can't or in a vacuum. They can't just go out and lower interest rates and then the whole market follows suit. No, it's a market of investors. And so interest rates are set, by millions of investors across the planet. And the Fed, sure, they could go out and just lower interest rates to 0 tomorrow. However, they would risk losing credibility and risk losing more of that certainty, and so they are kind of boxed in by the market in that way. Investors expect them to keep inflation under control, price stability. Sorry, that last chart. We're talking about growth versus value, because different stocks react differently to inflation metrics. And here you're seeing the Russell 1000 growth versus value, and this is a price to sales metric. And you can see that a lot of the additional pricing in of future growth has been in the growth stocks, and that has just meant like investors have been willing to pay a higher premium for those stocks. So the weakness that we've seen in the NASDAQ and some of the tech stocks and a lot of the software stocks this year, if this chart is any, indication, you might continue to see more of that based on the fact that that price to sales ratio has really gotten pretty extended when you look at growth versus value. So maybe there might be more room to run on the value trade. Now, what has changed in some of those large tech stocks is their CapEx. And we've been talking about this, the amount of money that these hyperscalers, as they like to be called, or the market likes to call them, are putting into CapEx, data centers, et cetera. And you can see Amazon, Microsoft, Alphabet, Meta. With the one outlier in the mags is Apple. And I don't know where Tesla falls on here. I guess they're just not including Tesla in the mags. But look at Apple really going the other direction. They've decided to kind of take a different route in terms of how they're going to build out on their AI. So that's an interesting strategic point there.
For people who don't know, Chris, CapEx is what?
Capital expenditures. And essentially it is like, think of property, plant, and equipment kind of being the biggest, easiest example of that. And so if you go build a data center, that's going to be considered, CapEx.
Right. If you're a construction company and you bought 5 new backhoes this year so you can do twice as many jobs, that would be a capital expenditure.
Yes. Yeah, exactly. So, and we've talked in previous shows about how the market traditionally has not, tended to reward equity prices when CapEx gets a larger and larger portion of the overall cash flows, because it's harder to judge the returns there longer term. Now, that CapEx as a percentage of cash flow from operations here, when you look at the hyperscalers in the dark blue, you can see that they have really overtaken two other sectors that spend a lot on CapEx. So telecom and utilities being the two major ones. I mean, as you can imagine, those two sectors would have a lot of CapEx. They have a lot of property, plant, and equipment that they have to keep maintained and install and everything else like that. Well, the hyperscalers, when you measure that CapEx as a percentage of the cash flow from operations, they're kind of going off the board here. So we'll see if that continues though, because, we don't even have time to get into it today with everything else that's going on, but private credit, there's a lot going on with private credit. What was it? Owl was in the headlines this week, that they are gating their funds, meaning they're not allowing investors to redeem at the rate that investors want to redeem at. And so, among other things like selling some of their loans to their own insurance company, they are also, excuse me, backing out on commitments to fund a data center for a large AI company. It was like $4 billion that they said, yeah, sorry, we can't actually finance that like we thought. So I think there's a lot going on in the private credit space right now under the hood. Very interesting. We'll see if it actually has an impact on the markets or not. But that's something to keep an eye on in terms of this CapEx.
And if you're trying to track, because I always am, trends in the narrative last spring and summer was the transformational power of AI, which is an inevitability, but is it a present inevitability? It seemed like a lot of money was spent between, whoever's throwing money places, whether it's private equity or companies themselves. And I guess they thought it was going to be an immediate return, because then after like Q3 earnings, all of a sudden like the bloom's off the rose, and by Q4 it's like now we're at where we're at. So as you're saying with some of these companies, they are looking to move other things around perhaps to cover for investments made last summer.
I will say too, and just an anecdotal here, I have a buddy who is an electrical gearing. So they sell like the switches and the gearing in all these mega data centers. And the demand for going on for these big data centers and these build outs and these mega scale, they're still going, man. It has not gone away. And I think it's wearing off some of its excitement in the news, but don't be fooled. It's coming.
Well, right. It gets into what you've always said, Daren, which is that S curve. You get that initial, like, it's going to be, and it seems like people thought it was going to be in like 2 months. And then when it wasn't in the fall, people were like, oh, okay, well, I guess we're done with that, But then the hyperscalers and these companies that are putting in the money, they're still cranking on the work. And then when you really start to see the returns, within year, 2 years, or whatever it may be.
Yeah, and I think they're trying to figure out how to monetize the large language models, right? How do you make money on it? But I think that's going to get figured out pretty quickly. I don't think it's going anywhere. They just have to figure out the monetization schedule. So it's kind of like invest all this and, oh yeah, we got to pay it back, but we're going to make dang sure this revolutionizes everyone's world so that we can collect on our investment.
Now, one of the biggest inputs for inflation, specifically the CPI inflation number, which is kind of the official number that so much of, things like Social Security, cost of living adjustments are based on CPI. As an example, roughly a third of CPI is based on housing, and they do it through something called owner's equivalent rent, which is a really weird, way to look at it. But underlying this is that housing is a big part of the CPI number. So when we got really high inflation numbers a few years ago, 22, 21, one of the areas that the Fed kind of was targeting with these higher rates was real estate. And that was because the prices had just run away. And as those prices were going higher, that was feeding into the inflation numbers in a big way. Well, we got pending home sales numbers again here this week, and again they're just in the housing market is just installed speed, right? Where the interest rates, other things have kind of flowed through to really put the brakes on the housing markets. And it's really stark when you look at this chart, seeing that the pending home sales are where we were in the depths of COVID. And it's been that way for, quite a while. So housing market's really stuck at the moment. And the inflation rate, so on the top chart, we've got the mortgage rate. On the bottom, we've got the CPI, the price index. And so now the price index has continued to kind of just go up a little bit, which CPI has been running, right around 3%. So each year, these prices have been going up about 3%. And going back to how does the fixed income get priced? How do the bonds get priced? Inflation is a big part of that. Well, mortgages are bonds. There's an investor on the other side of your mortgage that is buying that mortgage for the cash flows, for the return stream. And you can see here that the mortgage rates have really been pretty much flat since late 22. We're at 6% still on the 30-year fixed. And until they can kind of, really get inflation to work itself out and get those interest rates down, it's going to be tough to see any relief in the mortgage rates to help free up the housing market at all. And this was a great chart from Connor Sen. And he says, the slowest moving, but perhaps the most important chart in housing is the effective interest rate on all mortgage debt outstanding. And that ticked up 4 basis points in Q4 of 2025. So as you can see there, it's about 4.25. That means that, like, if you added up all the mortgage debt in the US, what's the average rate that person is paying? 4.25, pretty significantly below 6. So the people that have mortgages, the vast majority of them have interest rates that make them not want to move and not go into a new mortgage. So that's gonna slow things down. So as he says, housing can't meaningfully boost the economy until current mortgage rates are closer to this rate. Now, the other thing that's kind of helping drive the stall out in mortgages, and I think also playing through into all the kind of weirdness in leading economic indicators. There's been so many things that, like, we're like, well, this has never happened outside of a recession, or usually when you see this number, it's because we're in a recession. And yet the market has just continued to trudge ahead and not seem to care about it or respond in a recession type of way. I think that a large part of that is because of the drive of spending, and the economy is largely held by the baby boomers and the generation that is retired and has most of the assets, right? And this is a great chart from Charlie Biello, going back to 1989. The household wealth held by Americans 70 years and older was at 19% back in 1989. And you can see it was pretty flat until roughly the financial crisis. And then after the financial crisis, that number has just climbed, now at 32%. So a third of household wealth in the US is held by those 70 and up. And if you think about it, like, their spending is totally different. Their motivations are totally different. The way they spend, all these things. So the impact on the economy is massive, based on this demographic shift of the largest generation in U.S. history. Sorry, Dan, I thought you were going to pipe in with some wisdom there.
I was thinking about it. I mean, do you want to hear what I was thinking?
I don't know. Do I?
Well, I was just thinking this. So if you look at, and I'm not going to name anything specific, but many stocks, the S&P, if you look from 2008 to now, to Daren's point, often when the printing really started, you just see stocks just take off after 2008. And so you've got this generation of people who are 70 now, but they were 50 then. And what had they been doing? They'd been, as they were instructed to and required to in some cases, chunking away on their retirement. And so they have this 401k, which they had to have. And then due to forces that had nothing to do with them, that happened to be extremely valuable. So it would be as if like you were required to have a baseball card collection, Chris. And then for whatever reason, baseball cards like went off the charts. And now this collection, which somebody's told you had to have, is worth like 15x what it was before, and now you're like, well, what do I do? That feels like what the baby boomers are like.
Well, yeah, in some ways, I think that's true. And also, I think that they weren't all required to have it. And we meet with people every day that are like, hey, I've been a nurse for, 40 years, and I just put aside money every paycheck, right? Just diligently saved, never even looked at it, didn't even realize like how much I had or anything like that. Just saved regularly, right? I mean, we have so many clients like that, and so it wasn't just a stroke of luck, or they were just given it as a a requirement. A lot of people chose to put money in their 401ks or 403bs or whatever. Now the market's been done very well since the great financial crisis, so that has a huge impact on this too. So there's a lot of reasons. It's not like you can put your finger on one thing, but now that it is this way, I think it is having a big impact on the economy and therefore on the market. On just what the demographics have done over the last 20 years.
I think there's just, what I'm trying to say is there's sort of like a negativity around, quote, boomers, as that phrase is. And it's like, oh, the people who were trying to do the right thing, like saving money for themselves, and they did well. You're mad about that. It just, I don't know. It's interesting.
Yeah. Well, this is from JP Morgan showing the spending. Okay. So the percentage of overall spending, and we've talked about this in the past where, that's why it matters more. It matters less like the number of jobs, right? And it matters more on what that top 20% is spending on, and that they continue to spend, and they still feel the confidence to spend, right? Because that is what is driving a lot of the spending. So, and where is that sourced from? Well, when you look at the mix of assets, look at homes. Home equity is 26% of the total assets of the consumer balance sheets in the U.S. And other assets would be, taxable, stocks and things like that. Probably business ownership. A lot of the small businesses and medium-sized businesses owned by those folks that haven't retired yet, for instance. But when you look at the debt service ratio up in the top right, that's basically the percentage of debt to that person's income is very low. So the consumer is in very good shape. The average, when I say the average, right, the top that is doing that spending. While the other driver of interest rates, one of the probably the biggest driver of interest rates, is the U.S. government and the debt that they need to borrow, right? The big Papa Steve at the barbecue that comes in and needs the most food, the most demand, that is going to be the U.S. government. We talked about my old econ professor that used to talk about his Uncle Steve that would come, and everybody tried to get the food before Uncle Steve got there, right? Big Papa Steve. So when you think about the U.S. government and how much money they need to borrow, they're at the margin setting a big part of that cost of money, that demand for money, when you look at the supply and demand. And everybody knows the U.S. government's finances are not in very good shape, which is driving gold every day, it feels like. This from Hedgeye: gold's 30-day volatility is at the highest level since 2008. So usually when you see this much volatility in gold, there's things happening, right? And the market just has not seemed to respond to whatever gold is responding to at the same time. It's another one of those things. It's like, hey, this isn't super normal that everything's going up and gold is doing as well as it is. So anyway, it'll all make sense in hindsight, but that's where we're at today.
All right. Thank you, Chris. Daren, it's time. Fire up that screen share, buddy. I want to see those candles. Let's take a look at the technicals this week and see. You mentioned that the S&P is holding on for its dear life, and thoughts on oil and Mideast tensions. So how is that actually playing out in the charts?
Great question, Dan. So S&P 500, S&P SPY is just an index that tracks the largest 500 US-based stocks. Those 500 stocks split up into 11 different sectors. Each of those sectors throughout different parts of the market cycle perform in certain ways. And so what are we seeing right now with the S&P 500? So this look at the daily charts. This is looking at each one of these candlesticks represents a day in the market. And you can see this red line right here. That red line is the 20 period moving average. So basically it just takes, when we're looking at a daily chart, 20 days and then averages it across. It's kind of looked at as one of the short-term trading averages, an indicator of if the market is positive or negative. So the you can see we closed the day right on the line of that red line there, that 20 period moving average, suggesting that there's short-term weakness maybe here, but maybe not yet, because we're going to close right above that average. The market is very intentional, especially on a weekly close. So it closed right above that important line. And then you can see this 20 weekly moving average, which is the red line here. We came in, touched it, and then traded back above it. That's good news. Given the red candle we saw last week, we came back up this week. And so when I say holding on for dear life, that's what I mean by the S&P holding on for dear life. When we look at this, on a heat map, this is a visual way to look at the S&P 500. So these are the 500 cap-weighted stocks. What we're seeing is a rotation generally out of these bigger stocks into some of these smaller stocks, which is actually a healthy thing. Like, these stocks have just become too big, and we want to see that rotation happen. And you're starting to see that. We've seen a lot of improvement in more diversified portfolios this year than the concentrated portfolios over the last that we've seen do really well over the last few years. So when we look at this, you can see we still had the big dogs hung on this week, but lots of green under the screen. Utilities getting a bid, which is interesting because usually that's a risk off. Basic materials, consumer defensive, not doing super great, which is kind of a mixed read on whether or not the market's rolling over. Maybe we just have a rotation.
So before you bounce off of that, so just in light of the tariff news, if we're living in a culture of extremes, you would have expected this to either be, way greener or way redder. And this is a good color representation of meh, like just sort of a non-response to the tariff news.
Yeah, I was kind of surprised by that. When I saw the headline come through that the Supreme Court struck down the tariffs, I thought for sure that was going to impact the market more negatively. And really it didn't. It didn't really seem to impact it in any meaningful way, which tells you is it was probably priced in already. The market has already been kind of pricing it in and working it through. Doesn't seem to care. But like I mentioned earlier, you could actually spin it as a really great thing, because now, who are they going to pay back the tariff money to? Is it going to be the companies, the people? What is it? And it appears at the moment that, if you think about it, the Supreme Court just gave the Trump administration $150 billion check to inject in U.S. companies. That could play into their hand pretty nicely. So we'll see how that plays out. That's just kind of 3-level thinking there, but who knows how it plays out. I wanted to take a minute real quick to look at poly market, which is kind of one of the betting markets. Chris and I were talking earlier that the Federal Reserve in their minutes actually mentioned the betting markets. Apparently they're paying attention to the betting markets now as an indicator for the economic sentiment. But one thing we've really seen increase is here, this U.S. strikes by Iran by March 7th, 45% by the 7th, 53% by the 15th. It certainly seems like things are building significantly. We've only got an 18% chance that they hit it by February 28th. Then I always say, okay, let's look at the betting markets, look in real time, and let's look at, something like the flight tracker data. And when you look at that data, there is a more apparent, I've been kind of watching this for a few weeks now. And what I'm watching is this line from Israel all the way over to Tehran, and this flight path here, because if we start taking out Iran, you'll see a lot of there's a lot of things getting flown in both directions between Israel and Iran. And, the news can say what the news wants, but at the end of the day, when we start seeing all these planes start going on the either side of Iran and avoiding Israel, we'll know something's about ready to pop. So forget all the rumors you hear in the media. Just go to the flight tracker data to tell you if it's really going to happen.
Daren, what about the alien technology that allows you to subvert the flight tracker? We're going to find out about that this week too, right?
That was pretty funny. So for those who don't know, President Obama was on a podcast and basically said that alien life is real or something to that tune. I never really tell what they're talking about per se, and then someone asked President Trump, like, hey, what do you think about, Biden saying that aliens are real? And Trump said, well, that information is classified. Maybe I'll get him out of trouble by just declassifying it all. So yesterday he comes out and says, oh yeah, we're going to start declassifying all the alien stuff. You just can't help but wonder about the timing, right? Like Prince Andrew was also arrested yesterday for his ties to Epstein, or supposedly arrested. I don't know if he really was arrested or if that's just I don't know, it becomes such a Gen Xer when it comes to people actually getting punished for their crimes if they're politicians or powerful. But they apparently arrested Prince Andrew, and one person's been arrested for the Epstein stuff. But okay.
But anyways, aliens. But anyways, aliens.
I mean, you just have to wonder sometimes about the timing of things. Like, oh, okay, let's talk about aliens. Okay, if you want to. So anyway, that's kind of interesting. S&P's hanging on. When we look at the mags, this is the Magnificent Seven, right? This is an ETF that tracks the mags, and you can see it's really kind of turned and rolled over, and then found support here at the 60 number, and then bounced up. But we're still under kind of this zone here, and we need to break out above here to think we're going to get another run in the mags. Right now, I would just say this is a test of resistance. And actually, then next week, we would expect to see another candle down here. If it's going to roll over at that test of resistance, if we break above that, then we're into something different. Maybe we're a sideways channel for a while. I don't know. Per my conversation earlier, if we really step back and look at a longer term cycle, though, the trend is still up. I don't think how you can argue that. And I think people are like, yeah, well, maybe all these data centers are going away. I don't think it's going away. The amount of money being invested in data centers is obscene, and they are going to find a way to make their money back. I will say with the tariffs, though, today we saw an interesting bid in silver and gold with the tariff discussion, which I think that probably was reflected in the idea that given how tariffs are ruled, that there's less confidence in what's going on economically. So we saw gold catch a bid. We saw silver catch a bid. Maybe it's not dead yet. We'll see. But still, like from a charter's perspective, like we're still in that resistance area right here. And I think until that we work above that, we won't really know. To your point earlier, and to when we kicked off today, so last week we talked about oil, and we were looking at what's happening in oil, and you can see we had this red candle and it looked like resistance, and we're like, well, maybe things are going to calm down in the Middle East. We're still, it's not actually going to be a war with Iran, and then we got this pretty good sized green candle, which is the market saying, ooh, maybe not. Maybe oil things are going to heat up for a while. Interesting geopolitical tension, though, because if we take out Iran, we already took Venezuela oil away from the Chinese. At least we're charging them for it now, I guess. And if we take Iran's oil away from the Chinese, that's going to maybe calm things down with Taiwan. It'll put them in quite the predicament, though. And lo and behold, China and Russia decided to do some military drills over there. So things I think are heating up in the market might be indicating that. But again, going back to flight tracker data, we're not there yet. Betting markets suggest it's more likely, but not 100%. And Bitcoin left for dead. It is the poor, awful, hideous asset class. Who would dare want to own it? And it's over. Well, just kidding. It looks like what's happened is we're just trading in this sideways channel here, finding support on that 200-week moving average, which is, I think, positive overall. Doesn't look like it's necessarily bottomed, perhaps bottomed. It's consolidating, but I would not bet on that chart either way yet. There's just not enough confirmation in it for me. We get above 70,000 again, then I think we're back in the ball game. And but right now we're just looking like we're either hanging out in the bottom between 70,000, 60,000 in range. I think it's gonna be pretty tough for it to go much below 58,000 if it's going to remain a serious asset class. But for those who feel like, oh yeah, I never got in, this not a bad time, right? I'm not suggesting you should buy it because I don't know your financial situation, but if you've been looking for it, coming down into this blue line has historically been a good time. If you think it's still an asset class, it's going to continue to appreciate for you. It's not awful. Everyone always loves to buy it way up here. And then when it's left for dead, no more. The 10-foot pole, just saying.
Here's a perfect example too, to put it into a Sonoma County context. There were houses in 2008 and 2009 that were in the 200 and 300,000s that you, again, 10-foot pole. Oh, that's a foreclosure. That's a this, that's a that. And we sit here in 2026 and those, just look up what the appreciation on some of those. It would be a similar type of emotion around buying Bitcoin right now, kind of like houses in 2009.
Yeah, for sure. So I don't, again, I think you have to evaluate whether or not you think that Bitcoin is a viable asset or not, right? There's lots of speculation there and lots of feelings about it. I certainly have an opinion about it, but it's just an opinion.
Which is what?
I think my personal opinion is that it's a great time to buy. Like historically along this blue line, you can see has been an excellent time to buy it. Historically. If history's over, then yeah, you wouldn't want to buy it here. It's lost for dead, but it's right at a perfect kind of on sale period. This 200 period moving average over time has just gone down, support, gone down, support, gone up, support, gone up. Oh, now we're into support again. But notice the trend is up and to the right. That's when you buy. You don't buy up here when, Uncle Vinny's talking about it. I think it's actually good for all investors to have like those 2 to 3 people in their life that always buy at the top. And they're always the ones who text or call you back, hey man, thinking about silver. And that's the sign. Like, put your shorts on. Your canary in the coal mine people are remarkable.
The Uncle Vinny indicator.
Exactly, right? Those are perfect. So you need them in your life. What we are seeing though is RSP, which is the equally weighted S&P 500, and you can see it just taking off. And this is what I was talking about earlier, versus the SPY is kind of rolling over. When we give every one of those boxes in the S&P an equal weighting, S&P is on a rocket ship right now. And so I think that's why people might be a little bit confused. When you hear about the S&P 500 in the media, they're like, oh, it's the cap-weighted S&P 500 index. When you look at the equally weighted S&P 500, it's on a tear and doing really well. One of my theses that I have is that, we're going into midterm elections. The economy, they got to keep the economy going strong. If the Trump administration can achieve it, they're going to keep pushing money into the economy and keep pushing this thing. And now they might have actually just got a $150 billion check. So we'll see. But I think overall, pretty difficult to bet against the stock market right now. The thing is, though, the media is not reporting the equally weighted index to you all. They're just reporting the cap-weighted index. But the stock market is actually doing quite well when you look at it holistically. So
yeah, I'm not sure they even necessarily, the average reporter, I don't want to speak, who knows, but not a lot of people understand the difference between the two. And this, by the way, would speak to the advantages, at least at this moment, to working with an advisor or having a little bit more than just, quote, an index fund, because there's a lot of safety that people feel that way. They just throw out an index fund. Well, it just follows the market. Well, it follows depending on what you buy, it follows the weighted market, versus if it's all equal, you can see the difference right here at this moment.
Yeah, I think that's well said. I think most people don't know, right? And they think, oh, the market. Well, what is the market? Is it, the Dow that Blondie was running her mouth about in front of Congress or is it the S&P 500, or is it the equally weighted? And one thing that advisors help people understand, like, there's a lot more complexity to it. And so if you just bought the S&P 500, your year hasn't been as good as if you bought an equally weighted. But if you bought the equally weighted the last couple of years, you weren't happy because it wasn't ripping like the cap weights, because the mags, which were the big components of the S&P cap weighted index, were the ones that were growing. This year, they're down. And this is rotation, right? So you see these rotations towards the end of the business cycle. and it's certainly playing out great right now. We would expect. I say great as an advisor because, frankly, we found it quite annoying that all the money was flowing into the Mag 7 because everything in our brain as advisors goes, man, you can't concentrate like that. That's a bad move. And that's very frustrating to watch a market just rip when it's not promoting good behavior.
So to our clients who are hanging tough, we love you. What we've always talked about is at least happening at the moment, the rotation. Daren, any others, or you sound like you're wrapping up there?
No, I think that's what I wanted to hit today. I think overall market looks really strong, and don't bet against it at this time. And I think there's some things coming at us in midterms, and historically, it's not a good move to bet against the market going into midterms.
I want to clarify that this graphic we used this week was trying to show shipping routes via air and not missile strikes. So no tariffs, or at least less tariffs, massively less tariffs. Now what? The answer is, at least at the moment, not a strong reaction one way or another from the market, and potentially if there's 150 billion that may be being refunded directly to companies, that may have a huge impact on the market. And depending on how you're invested, you could be sitting good right now. Thank you so much for checking out our show. This is On the Markets. We are Sonoma Wealth Advisors, the private wealth brand of Fermata Advisors, the Fermata family of brands. Wherever you found this show, please subscribe. We'd love for you to subscribe so you don't miss future episodes, whether it's Spotify, Apple Podcasts for the audio, the full video broadcast on YouTube, and also on our website, sonomawealth.com, where you can learn about our wealth analysis. We will see you next week.
You're up to date with Fermata on the Markets. Learn about how the Fermata Advisors family of brands can help your family and business in finance. Sonoma Wealth Advisors, a comprehensive, holistic finance solution offering financial planning, asset management, and tax planning. Take our free wealth analysis now at sonomawealth.com. Fermata 401k, business retirement solutions for small and large companies with a fiduciary commitment. Learn more at fermata401k.com. Fermata Tax, personalized tax services for yourself, your family, or your business with an emphasis on efficiency. Find out how at fermatatax.com. If you haven't already, like and subscribe to Fermata on the Markets on YouTube, Spotify, and Apple Podcasts. Fermata on the Markets features human hosts, editors, and voiceover talent. Music by Dr. Delight on Soundstripe, voiceover by Joan Ellaway Nash. Thank you for listening to the very end. We appreciate diligent viewers and listeners. Fermata Advisors LLC is registered as an investment advisor with the SEC and only transacts business in states where it is properly registered or is excluded or exempt from registration requirements. This content was produced by Fermata Advisors LLC, DBA Sonoma Wealth Advisors, DBA Fermata 401k, DBA Fermata Tax. The opinions expressed by Fermata Advisors LLC on this show are their own. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.